For the first time in a while, cash has not been trash for investors, but it may become trash again pretty soon. So I want to dig through that a little bit today. I think this is an interesting subject, talking about investors maybe moving out of cash balances that they've accumulated over the last few years.
Over the last couple of years, cash has, like you said, not been trash. Leading up to the pandemic with rates at zero, essentially, cash was referred to broadly as trash. It yielded nothing and just inflated away over the years. And so recently, there has been a real yield on cash, the yield on cash being about 5% up until this most recent Fed cut, which has been in excess of inflation. But you're only yielding really about 1% on that at this point. But before we get into all of that, it's provided a nice safe haven for a lot of dollars. Right now, we're at all-time high record levels of cash and money market funds. But while it's given that security that, just being uninvested gives, it's really significantly underperformed broader markets over the past couple of years. And so, as we're going down this rate cutting cycle, it's really, the question of where is this cash going to go, or are people going to keep it stuck in money markets?
Yeah, really the best time to be holding cash was in 2022 when equity and fixed income markets fell. It was one of the worst years for the 60-40 portfolio on record. That would have been a great time to have cash. Yields were climbing on the short end, so your cash was getting more and more if you were in money market funds or CDs. But the thing is, over 2023 and so far in 2024, cash has lagged the market significantly, both fixed income and equities by a substantial amount. And so while you can say, hey, I was getting 5% on my cash in my money market fund, well, for a period of that, you weren't really covering inflation by that much. Now you're talking about covering inflation by, 2 to 3%. On an after-tax basis, you're talking about even less because cash yields are typically taxed at regular income. And so you're talking maybe on a tax equivalent basis, that's a 4% maybe after-tax yield on a 5% money market. And those rates are set to decline. So the thing is, all cash rates are paid at the very short end of the yield curve, which means, overnight rates essentially. And that's what the Fed directly controls. And so now that we're seeing rate cuts, that's going to directly lead to decreases in those money market rates. And it's going to force investors out of cash. And I think more broadly, cash was not necessarily viewed as such a yield generating asset over the last couple of years, but as a recession hedge. Well, now we've seen recession odds have gone down significantly. Looks like we're going to get that, soft landing for the economy. And people are starting already to chase this equity rally and what we believe will be a pretty investable environment over the next few years.
Yeah, exactly. And, my comment on the 1% yield or real yield on cash, that's essentially after tax, after inflation and everything. And like you said, rates are coming down. The Fed already cut 50 bips. The market's pricing in about another 75 this year, 50 to 75. And then 1 to 1.25% next year. And so by that time, you're talking, you're down to about a 3% yield on your cash with, a 2% inflation target. And, are we going to stay exactly at 2%? Maybe not. It might be a little bit higher than that, but call it a 1% yield on that. And then you have to take taxes on top of that. It's going to turn back into what it's been for a very long time, a non-yielding asset, a recession hedge, a convenience item.
Absolutely. And so I want to talk a lot about the cash that's held in money market funds. So money market fund is essentially, for those listening, is in very, very short-term government bonds. Typically, that's your safe money market fund. It's government debt backed, but these things are turning over every single day. So as you said, as soon as the Fed shifts down interest rates, those money market rates are going to follow within the next week. And so we've seen, for example, like the Fidelity money market rate is at 4.6% or so right now. So it's just right behind where the Fed funds target is, and that 4.75 to 5%. So if we see, like you said, another 75 basis points or 0.75% of interest rate cuts into year end, you're talking about a yield that's going to be under 4% on cash starting in 2025, probably under 3% by the end of 2025. And so the question is, for all these people who are in money markets, where do they go? Well, right now there's $6.5 trillion with a T, trillion, in money market funds. And that's going to have to find its way into the market in other ways, because to your point, it's going to become essentially not a non-yielding asset, but if you're talking about on a real yield perspective, you're not going to be covering inflation by that much. And so you're going to be looking for other opportunities for that cash. And so as we kind of decide, how much of that's really going to flow out of current money markets, it's important to look historically. If you look back into the kind of pre-COVID timeframe, 2019 and before, you had closer to around 4 trillion or less in money markets. I mean, basically from post financial crisis to 2018, you had somewhere in the 3 trillion range. And so you're talking about substantially less than we have today. There was a pretty significant cash flow into money markets as the Fed was hiking rates back in late 2018, 2019. But we expect as rates fall for that to flow out. And so the real question is what kind of assets that's going to go into. I mean, your traditional asset classes, equity, fixed income, alternative investments are all areas where investors are going to be looking for better yield on their investments.
Yeah. And so we've talked about the tailwind that those markets are going to be receiving from rate cuts, but there's also that secondary effect of all this cash sitting on the sideline that needs to find a new home, because, a lot of it's there for yield. Like you said, money market balances are significantly higher than they have been in recent years. And that's primarily due to yield and not due to people just need more cash because they have more things that they want to spend it on or anything. Consumers are spending well, but that's not what's driving these, extra $2.5, $3 trillion of money market funds right now. So all of that money, like you said, needs to find a home, providing that nice tailwind for all of these assets out there. And so in part of that too, beyond just the money market effect, talking back a little bit more on the rate cuts in general, is that'll really help those non-yielding assets, your gold, silver, your precious metals, commodities, as well as things like Bitcoin and Ethereum, your crypto assets, because they're, broadly, at least in a, ETF sense, they're non-yielding assets. And so lower rates make those less costly to hold.
Yeah, that's exactly right. I think that's an interesting dynamic because, typically you're not looking at cash as a super high yielding investment, but it kind of has been recently. And so now those other things are going to come into better balance. And so, looking to where that money is going to flow is really important. And of course, is what you and I are looking at from an investment perspective. Now, I also think from kind of a consumer finance educational aspect of how much cash is appropriate to hold. Well, for anybody, I think in case of an emergency, you want to have cash ready in case you need to, commit some spending to things that aren't anticipated. So for anybody listening, you want to make sure you have cash balances either in your bank account or in your, investment account that can cover, whenever you may encounter some kind of unanticipated event that's going to take money out of your pocket. I think for anybody within the next year, if you have, spending already planned within the next 12 months, if it's a specific date, you can put it in something like a CD or short-term treasury that's going to yield a little bit better than cash for, that fixed time frame. Hey, if I'm going to buy a house in 9 months and I expect my down payment to be $100,000. Okay, maybe I lock up $100,000 in a 9-month T-bill, 9-month CD, get a little bit better than cash. It's not going to be substantial, but at least helps a little bit. Every dollar counts. And so, more money in your pockets, better than fewer. So I think that's sound advice as well.
Yeah, exactly. And then further on the unexpected expenses, preventing against a downturn kind of thing. Like you want some money that's a little more easily accessible, more resilient to bad economic times. you're going to be like pushing out your duration a little bit, talking about like a medium term 4, 5, 6 year treasury or, corporate debt kind of range to keep getting a little bit more of that yield that you're going to be missing out on the short end of the curve.
Yeah. And then I think when you're talking about long-term investment perspective, you can, put that money towards, like you said, higher quality fixed income. Preferred shares are a great area if you're looking for yield and maybe some appreciation on those assets. Those can offer really nice dividends. Or if you're looking for, you've got a longer time horizon, put it into the equity market. That's going to grow. Of course, it is going to be more volatile. But if you're investing for the long term, we expect at least in the near term, next few years to be in a good investable environment. But over, a 5-10 year time horizon, it's always a good time to invest. And so I think, it's a prudent approach to use that. And I think to your point before is it's always prudent to have some amount of cash in your portfolio, because like we like to do at Bet Capital is invest tactically whenever you get these short-term drawdowns. I mean, we talked about, back in July when you had the labor market hiccup and everybody freaked out and the market dropped 10%. Well, that was a time where you can use that tactical cash to invest back in the market and really benefit from that kind of V-shaped recovery that you get in markets when everybody freaks out from a short period of time.
Yeah, those tactical opportunities are great to, deploy that cash that you have on the sidelines, at least for a short period of time before you build that cash buffer back up. But I want to, reinforce the point that we made a few podcast episodes ago that you shouldn't be afraid of getting invested at all-time highs. We've notched over 40 all-time highs so far this year, and continue to march higher. And so it's one of those things where you can't be afraid to put the bulk of your money to work at any given time. I mean, obviously sometimes things look more inflated than others, but don't sit on the sidelines waiting for that opportunity, that big pullback, because it might be a 10% pullback 20% from now.
Right. I mean, this is going back to our episode about investing at all-time highs. We've seen 40 plus all-time highs on the S&P 500 this year. If you decided that first all-time high of 2024 wasn't for you, well, you missed out on a lot of equity gains. So I think that's certainly important to think about. And so I think like the main takeaway here is that all this cash on the sidelines in money markets, like I said, $6.5 trillion. We expect 2 to 2.5 to be flowing out. If you're an investor and you've been happy holding cash, seriously think about moving out before the rest of the market does, because that movement out of money markets is going to create a modest tailwind for broader assets. It may be a little bit more so for fixed income, because if you're still talking about conservative capital, but certainly assets like equity, alternative investments will benefit from it as well.
Yeah. Great points, Victor. Thanks.